Hey everybody, this is Jose Blasco. We are about to get started in 40 seconds. Sound check, please, everybody. Let's have a quick message on the chat box. A quick hello would do, so that way I know you hear me. All should be good to get started, but it's always a good thing to do to have a quick sound check, guys. So very appreciated if you could just type something nice on the chat box, so I know you heard me. And we are starting in 20 seconds. Very good. I will turn on the video stream. So I position myself there on the bottom right corner of the screen as always. This is my spot, and that way we can get started now in 3, 2, 1. Time to get started. Very good. Thank you everyone for that. We are now live. Today is April 28, 2021. Welcome to Options with Options. My name again, Jose Blasco. I'll be leading the session. Today the session is about options, like the name suggests. The beauty, I always say it, options give you options, meaning that we can always find ways to adapt to different market conditions, and that makes it very, very handy for traders where we need to navigate and survive, stay safe in those variable and changing market conditions. Okay, so let's have some fun and let's be smart with our applications during the trading session. Before we get started, we are going to highlight the disclaimer on the upper left side of the screen. Please read it carefully. It's a financial disclaimer. It's important stuff. It's important information. So important that I'm asking you please to read every single word. Do not skip it. I'm counting on you to not to skip it, because indeed it is important information. With all of this said, I believe we are ready to talk about the agenda for today, starting with a quick hello for everyone, we just did, even though some of you are a bit shy on the chat box. So don't be shy, just say hello to everyone. That's nice to do. We are simulcasting. That means that while this session is taking place in places like YouTube, Facebook, it's also taking place in our private room in tradewithufos.com/live, which is within our website. Basically, one of the consequences of simulcasting is that depending on where you are at in the world or which platform you use to watch it, YouTube, Facebook, or the private room on our website. So next thing you know, there will be different quantities or different durations for the video lag. So there may be times that you are watching the session, and if I show the clock, the difference between you and I, maybe 10 seconds, maybe 20 seconds, maybe 5 seconds. So just count on some video lag during the session because of the nature on how video is distributed through the video distribution networks. And then on the other hand as well, just know that in the private room, we do the sessions with full duration. And when you attend the sessions in the public spaces such as YouTube, Facebook, and so on, then the durations are limited in time. The content is exactly the same because trading is trading, but basically the differences are two. Number one, to attend the sessions in our private room, you would need to subscribe as a coaching plan member, which has a monthly fee or yearly, depending on your choice, where Facebook and YouTube and so on is obviously free. Then in the other hand as well, what happens is that some of you are looking at trading from a, let's say, hobby point of view, part-time, or you are very busy and you have less time to trade. So then those free sessions on YouTube, Facebook are probably good enough for you, and they're free because the content is the same as the content from the private room, even though the duration is more. So for the ones of you that you are like me, that you are very passionate about trading and you never got enough and you always want more, so then probably the best choice for you would be to become a coaching plan member. You can subscribe on our website under the coaching session. You can just, coaching section, I meant to say. So you can just subscribe there. And for the ones of you that are just looking at trading, still seriously, but more as a part-time thing, then I guess that YouTube and Facebook will be good enough for you. So with all of this said, we're going to look at the market, review the trades that we have, and then look for new opportunities. Okay, and again, expect this session to stop streaming in about 30 minutes on the public streams and continue for the full duration on the private room. So let's begin. Christian, how are you, my friend? It's good to see you. You arrived right on time. We just got the session introduced, nothing that you don't know. So we are now beginning and you didn't miss anything. So very well. Anyway, so S&P, so what's going on? Well, what's going on is that a few days ago, we got a tiny, tiny, tiny change of climate, and then we went back to, blue. Okay, blue and confirmed. So that unlocks, based on statistics, unlocks. This is candle number 3 out of 9. So this unlocks potential for the market to keep going higher, as we were kind of expecting, with so many green UFOs showing up below price. So it's like, yeah, statistics suggest the climate should change, but it cannot go that far down low unless all those buy orders get canceled. Okay, which is possible, but is kind of unlikely. So this translated on this very shy red dot, and from there back to blue. Okay, so what should we expect? Well, unless something major happens, we should expect the S&P to continue moving higher. More UFOs showed up in recent times, and when you look at the VIX, so what are we likely going to see? The VIX, going down 0.85% down today, into a green UFO, which has been pushing the VIX back up multiple times. Okay, and now it's coming down, right? So those unfilled orders are being filled, and it may continue going lower, which would be in line with the S&P going higher. So we have that type of environment. Now, remember, things in the market can change in an instant. Some whatever happens out there in the world, and next thing everything gets panicky, everything gets crazy. So as traders, it's good to know what's happening, but at the same time, we don't want to develop any sort of bias. How are you, Siderman, Fermon? How are you guys? So you don't want to develop any sort of bias where now the only thing you want to do is this type of trade just because, right? So we always need to be ready to hedge. We always need to be ready to be wrong. We always need to be ready to be right. Okay, no biases, just applying our methodology based on its rules, and not much thinking. Okay, because again, we're not here to kind of play a prediction game and be proud of the prediction just because we got lucky. We are here to play probabilities with tools that allow us to manage the risk. That's what we're doing. So when we're right, we benefit nicely. When we're wrong, we suffer in ways that are not that problematic. And with odds in our favor, you can then have a tool to create consistency. Okay, that's the goal. So again, talking about the mindset of a trader. That's what I was mentioning now. So let's review our trades. At this moment in time, we only have one trade running, which is COP. This is the only trade that we have in the account doing its thing. We had this very sharp moving price to the downside, all the way to here. And then the last time we were in the session, we saw those green UFOs show up. And guess what? This allowed for more UFOs to show up, and even for the climate to change from red to blue. So that's a good news, because it brought price back to somewhere in the middle of the range, which allow us for more of those tweaks that we do, isn't it? More of those rolls, and that's very nice. Now, what's even nicer, I would say, is that there are many red UFOs above price. So this blue climate should have a certain difficulty to progress. Okay, we are likely going to see something going up, going down, new UFO forms, going up, hit the next UFO, go down, new UFO forms, and something like that. Okay, and as time goes by and we stay within the range, then the front week expiration options keep decaying, and we can roll, and most importantly, we are exposing ourselves to the earnings, okay, here with this trade, which are going to happen on May 4 for COP. Okay, so let's take a look at the volatility to see how much volatility has been increasing since we entered this trade. Okay, so implied volatility are all options. Okay, and in this case, we can see, let me make this larger. Okay, so we can see that since we entered, okay, so we entered this trade when volatility was 0.35, as you can see here below, and the current level of volatility is now 0.37. So there's been a little bit of an increase of volatility. It's only 2%. It's not major. Earnings are happening a bit later, on May 4. If we were to look at what happened other times, So you know so you can see this is like the earnings day, so we look like 6 days before, something like that. 1 2 3 4 5 6. So 6 7 days before earnings, which is more or less now, right? So we should see that increase in implied volatility. In that prior cycle of earnings, it went from 52 to 55 to 65, sorry for that. Okay, so 52 to 65, that's like a 10% move in increase in implied volatility. So far, we only seen 2% increase. So we should benefit from more increase of volatility, right? And the longer we stay within the range, and not only the time passing decays those other options that we can then roll, but on top of that, it increases the options that we bought because of that effect of implied volatility rising. So that should put us in a very good position. So let's analyze the risk profile of what we got in our hands. If I show you TOS first, you will see that we can see here $69.50 of profit, but it's actually more than that because we already closed and rolled a couple of times, so there is more. Notice that the last time we were in the session last Thursday, we closed the 56 call. Okay, we close it, and we have an order there to sell it again at the same price we sold it for in the first time, which was 31 cents. We have not been filled yet. Okay, why? Because we haven't reached that mark yet, and this option is still trading for 10 cents only. Of course, it's going to expire on Friday, which is around the corner. So probably we are actually dealing with distorted Greeks, and we may need to do something about that. Okay, so we'll talk about that in a minute. Yeah, we'll talk about that in a minute. Okay, but in the meantime, let's begin with the risk profile so we understand better what we've got in our hands so far. Okay, so COP. Okay, COP. Everybody very silent. Okay, everybody very silent. You don't need to be that silent. Okay. Good. So what do we have? Okay. So the trade that we have on right now. Okay, let me make sure I make no mistake. Because the first one and the bottom one look almost the same, isn't it? Yes, correct. Correct. Yeah. So the trade that we have right now is the one in the bottom, the one that is highlighted in the bottom. After the multiple rolls we have done, the cost of this trade is $15, 15 cents. So the most you can lose is $15 per contract. Okay. We are, notice it says 1 minus 101. What does that mean? It means that we currently own the 7 May expiration 50 put and 56 call. We are short the 50 put that expires in April 30, okay? But we did not sell the one, because after April 30, it's May 7. So if I was to try to sell the 56 call that expire in May 7, what I would actually be doing is closing this one, okay? So, we cannot do that for obvious reasons. So that's why I placed this order to sell it for 31 cents, but we haven't been filled so far. If I look at April 30, 56 call, okay, notice that is trading at 9 cents, and our order is to sell it at 31. So that's why we have not been filled, and it would probably take a pretty significant move to get to those levels. Okay, that would be about that stock should rise at least to $55 a share to be able to get filled at that price. Okay, so in the meantime, that's not a problem at all, to be honest. Okay, we are happy traders with this trade. So because what happens, the fact that we got rid of the upper call opens the door for the more that stock rallies, the more we profit. So currently we are making a net profit of $77.50 with all the various rolls that we have done. Okay, but if that stock was now to report earnings and jump strong to the upside, okay, so what would happen? well, you will end up, profiting somewhere here, which is going to be a much better result. So now if it goes down, again, the most you will lose is 15. Okay, so we are in that particular position. Now, I am wondering, since that stock went up to $53.20, I'm wondering about the 50 put. What are we dealing with when it comes to the 50 put? Because maybe that 50 put, it's to be closed. Okay, so 50 put. So let's take a look at what we have here. So we have a stringent value of 6, theta is 6. So notice that we are dealing with distorted Greeks, okay? Distorted Greeks, meaning that if you take the amount of days to expiration, which is 2.5, and you multiply times the theta, that will tell you that, you're gonna collect like, let's call it 15 cents on time decay, but the price of this option is only 6 cents. So there's no way you can get those 15 cents at a rate of 6 cents a day if the value of this option is actually 6 cents. So we are dealing with distorted Greeks, given the fact that expiration is approaching, this option is far out of the money. So we are experimenting that, okay? So what are we gonna do? We are just gonna close it, okay? We're just gonna close it. The bid and the ask is 5 and 7, okay? The midpoint is 6. Let's do it for 5, okay? Let's place an order to close it at 5. If you close it at 6, it's fine. But with certain platforms like Thinkorswim, which I'm using here, you pay no commissions when you close options for 5 cents. And therefore, we're going to add a closing order to close that one for 5 cents. The current price is 7, so we may not get filled until later in the day or even tomorrow. So that one, I will make it good till cancel. So whenever that happens, it happens. And then we will get rid of that one. And then the risk profile is going to be then the risk profile of a long strangle, because we're going to be left with a long call and a long put. The beauty is that because we have been doing those roles, that long call and that long put basically cost us 15 minus 5, 20 cents, which is $20. So the most you can lose is 20. And now if you got a jump on earnings, the amount of profits you could make are going to be significant. So I'm just going to place this order again one more time and make it good till cancel. So if I don't get filled today, I'll be happy to get filled tomorrow, because the Greeks are distorted. So anytime I get filled, I'll be happy to take the fill. Okay. So looking good so far here, even though we cannot go beyond these analyses and other things that we could do here. Given what I just said, okay. So we need to get rid of that option first, okay, and then from there we will assess, okay. I mean, let me anticipate for you guys what is it a next step that could be valid. So one next step that could be valid is to do nothing, okay. That's one step. So let me explain why. I'm not trying to be funny, I'm serious actually. So if you were to look at the trade we currently have, right? Let me do this. If not, I cannot copy. Duplicate, right? So if we were to look at the trade we currently have, and we were to make this 0 and 0, okay? So we are left with two long options, which is the long 50 put and the long 56 call, okay? And these, by the way, would have cost us 20 cents, okay? Because it's 15 minus 5. We're giving out 5 cents by closing the option with 5 cents, right? So we are giving up 5 cents. So if you were to end up with this particular trade, notice what the trade is, okay? So it's the most you can lose between 50 and 56 is $20. But then if you got a jump in price, okay, so now you can make a very, very nice profits. So this is the risk profile that we have, okay? But my intention, okay, would be to do this. So again, let me just add a couple of ones just so I can copy. If not, it doesn't allow me to copy. So now I'll make it back to 0, okay? And then I'm going to show you what is it that we could do. by moving to May 7 expression. Okay, and now we're gonna convert the double calendar into a double diagonal, or I should say a dual diagonal in this case. So we would sell a call above the call, for example, 57, and we would sell a put below the put, for example, 49. Okay, and so the cost of this would be the following. Okay, so if you take, you know what, let me do it differently. So I'm gonna get you less confused, because this is, at this moment in time, it's probably a bit confusing. Okay, I got too many things here. So please allow me to do some cleaning. Okay, so I'm gonna simplify this a little bit so you will understand better in terms of typical option strategies. Okay, so again, so far what I said is, this is the trade that we have. Okay, well, we have 1 minus 1 0 1, meaning that we closed the call last week and we are about to close the put now. So then we would be left with 1 and 1 if we do that, meaning that this is going to be a long strangle that instead of $15, that would cost us $20, and now we are exposed to an earnings jump with very little risk, which is only $20. Okay, so that's where we are at in this series of tweaks and rolls that we are doing. The next step would be, okay, so please allow me to add two simulated things here, and then I will explain. Strangle. Okay, so let me do some cleaning. Okay, let me do some cleaning. So we are talking about 56 call, 50 put. Okay, and that is 20 cents. Okay, so let's do this. I'm just gonna get rid of that one. Okay, here we go. So what we have now is, the moment we close the put, we're gonna have a strangle, which is 50.56, okay, using May 7, and that cost us 20 cents. Okay, so that's the trade. Now, the one thing we could do is to go ahead and using May 7, notice I'm talking about May 7 here, okay, which is the expiration date that coincides with earnings. Okay, we can go ahead and sell options, but not inside, because these would carry risk. We're going to sell options outside the range. Okay, so this now becomes, from a strangle, we're going to convert it into a dual, how do I call it? I just got mixed up myself in my head. So because this is using the same expiration date, this is going to be a dual vertical spread. Okay, you got the call spread and the put spread. The thing is that you have been financing the trade by doing rolls from the double diagonal, the double calendar, and therefore it's gonna cost you very little money. Okay, and sorry guys, I'm just a bit mixing some of the terms, given the fact that it's been a long day for me here in this side of the world, and I just kind of probably confused you a bit. So I'm gonna repeat it in a minute. Okay, but notice what happens if I add the strangle, where I sell the 57 call on top of the 56 call that I have, and I sell the 49 put, okay, on top, or I should say below the 50 put I already own. Okay, so what's going to happen to my risk profile? Well, now it's going to look like that, meaning that worst case, okay, now no matter what, you're going to make $43. Okay, and if the stock jumps on earnings and goes beyond 57 or 49, which are the two new strikes I'm picking, so now you're going to make $143.50. Okay, and the beauty is that this is 100% risk-free. Okay, it's totally risk-free because we've been, it's kind of like, it's not the right term, but it's kind of like we've been legging in to building this position by starting, okay, and now I repeat myself, by starting with a double calendar and then rolling to end up with a strangle. And with a strangle, now, instead of selling options that use the same strike, because the double calendar uses the same strike when you buy and sell the call and the put, uses different expiration dates, but same strikes. So we've been rolling, tweaking to a point where we've been left with the long units only that expire in May 7. So what do we do now? Now, using the same May 7, we are now selling the 49 and the 57, which is above and below the range, locking in some credit that makes now the trade to be risk-free no matter what. So we are above zero, above $40, more or less $40, no matter what. And then if you have a jump, on top of that, you're going to make the difference between the strikes, which is $1. So the difference between 50 and 49 or 56 and 57 is $1. So you make $1 plus 40 something dollars, which is $143 of profit, no matter what. So this is the beauty of playing, this type of trade the way we have, which is, to little by little position yourself to be in a risk-free position. And now, the bigger the jump on earnings, thank you very much. And if nothing happens, you still made $40. Okay. So that's the idea. So could you guys please confirm to me that all is good? Hey Joanne, how are you? Well, we just reviewed the COP trade, Joanne. Maybe I can do a little bit of a recap, so you have a good understanding of what happened with this trade. In any case, little advice for everybody. We've done some pretty major updates on the website, and more to come, by the way, because we are about to launch our apps for MetaTrader, next week or the week after, something like that. So we are doing pretty big enhancements to the website and the technology behind it. So I recommend everybody, no matter which section of the website you go, I recommend everybody to delete your cache, your browser cache, your cookies, and kind of have a full refresh of your browser, because probably there must be, given the type of changes that have been done, there must be some conflicting information on whatever your browser has stored. So it would be good to kind of reset your browser so you have a good experience using our website, again, given the changes that have been done. Okay. Anyway, so little recap here, okay, which I believe would be helpful for everybody. So on April 14, we ended up building a double calendar with this particular stock COP. Double calendar is a trade where somewhere in here we bought a call and we sold a call with different expiration dates, and somewhere in here we bought a put and we sold a put with different expiration dates. The beauty of this trade is that if volatility was to rise, you profit a lot. And we were expecting volatility to rise because earnings are approaching. Okay, so that's why we put the trade in place using May 7 expiration, because May 7 expiration coincide with the expiration dates where earnings are priced in. In the meantime, since April 14 all the way to now, we've been rolling the options that we sold and using then the next expiration week every time we did those rolls, collecting premium, locking in premium, selling new premium, collecting premium, locking in premium, and again and again and again. So what happened at this moment in time, after doing that a few times, we ended up in this position right here, okay, which is a position where, worst case, we're going to lose $15 per contract, because this is the current cost of what we have after the multiple tweaks we have done. And prices here, so this trade is currently making $73 per contract. And now if the price of the stock was to rally, you can make unlimited profits. So beautiful. Now, we are not done yet. So the one thing we just did is, okay, we still have +1 and +1. So this is the 50 puts we bought and the 56 call we bought. But then we have -1 and 0. Okay, so -1 and 0 is the put we sold, which we still have, and the call we sold that we closed last week. Okay, that we closed it last week, and we did not manage to sell it again because it never got to 31 cents of premium, which is what we are asking with our sell order for 31 cents. Okay, so we are still waiting to get that call filled. Okay, and maybe one day it will. But in the meantime, we saw that the put had distorted Greeks, and therefore we are ready to close the put for 5 cents. It's currently trading. The last trade that took place was filled at 6 cents. So hopefully, I don't know. Let's say 1 hour from now will be filled, or worst case tomorrow you should be able to get filled on that put, because we are 1 cent away from the price we want. So the moment we get that put filled, so what's going to happen is our risk profile will change from that to this, which is a strangle that instead of 15 cents cost us 20 cents. Why? Because we are closing the put for 5 cents, meaning that we are giving up 5 cents in this trade, and therefore instead of 15, now it costs us 20. So what's the most you can lose now? Well, the most you can lose now is $20, which is if price stays within this range, okay, between 50 to 56. Okay, now if price moves up or down, with the earning reports being beginning of May, price may gap and jump. Okay, so now you can make a lot of money either on the upside or also on the downside. Okay, that's powerful stuff. But again, the range between 50 and 56 is quite wide. Or you can even have the stock jump down all the way to 44 and then rally back up, and on expiration date is trading at 53. So you end up losing $20. This could happen too. So what are we going to do to offset that problem? Well, the moment we get filled on that 50 put, okay, and we are in this position, we will turn around and sell a strangle against the strangle we own. We've been using 50, 50, 56, 56. That was a double calendar, okay? So we are now going to move from 50, 49 and 56, 57 using the same expiration date, May 7, for both the long strangle as well as the short strangle. Okay, but this is not an iron condor, because an iron condor means that the options you sell are closer to price and the strangle that protects is outside. In this case, it's the opposite. We're going to sell options beyond the options we own, meaning that this is technically a double vertical spread. So it's not a double horizontal or a double calendar, which is the same. It's a double vertical, which is a different strategy. And if we were to do that, again, with earnings approaching, right now we are getting 66 cents, 63 cents. Volatility is pointing at 48%, which is good. But again, maybe 1 hour from now, you may get 67 cents instead of 63. So this should go up as earnings are approaching, because we saw based on volatility that volatility may rise all the way to 10%, where we've only raised 2% so far. So there may be more room for improvement. And if that happens, it'll be great. If it doesn't happen, we're going to sell it anyway. And the moment we sell it, this is the new risk profile that we're going to get. This is a risk profile where if price now stays between 50 and 56, which earlier that would imply a loss of $20. So now this implies a profit of 43. So no matter what, you cannot lose any more on this trade if you do this strangle against the strangle, right? Okay. And now if you got a gap or a move in earnings, which is significant, and that market is trading below 49 or above 57, so now you're going to make this amount, okay, which that amount is $143, which are the $43 we just discussed, plus the distance between strikes, which is $1 between 49 to 50 or 56 to 57. So that's going to be your 143. So again, risk-free trade, worst case, make 43, best case, make 143. Okay, and now you just let it be, and you just wait for earnings to happen, for the stock to go crazy, and hopefully it does move a lot. And if it doesn't, you still make 43. Okay, so that's the idea behind all of this tweaking, to end up in that risk-free position with all of these advantages, which hopefully makes sense. So yeah, so we just need to get filled on the put so we can continue. And now it's time to go ahead and begin looking for new trades. How is it going so far, everybody? Before I start, I would really like to have a little bit of a confirmation. This was a bit intense to begin the day with, lots of information. Hopefully everybody's following. And if you are, I would love to know. And if you're not, I definitely need to know as well. So please, everybody, please, can I count on everybody to type something on the chat box? It could be as short as okay, no, okay, or a long explanation, whatever you choose to type. But please, everybody, go ahead and give me some feedback so I understand where you're at. This is as you can see, this is powerful stuff, but it's certainly sophisticated. It's complex. It's not go long, go short, done. I want to make sure everybody gets it because making mistakes is very easy, isn't it? So I'll take a sip of water. Very good. So should we put the closing order as an OSO? Um, the closing order as an OSO, I would not think about why would you want to do that. I cannot think about a reason to do that because you are not doing something, and as a next step of that one thing, you want to close for 5 cents that option. It's not the case. You have this put in the account since days ago, since the last week, and now today you concluded it's distorted Greeks. Let's close it. So it's one order. There is no prior order before. Is that making sense? You can be quite simplistic on the execution of these tweaks. It's you don't need to kind of automate. If this that happens, that happens. If that happens, that happens. You don't need to have a complex order sequence. You can just keep it very simple because, as you can see, it takes days for things to happen. You need the decay, you need the volatility to rise, and things like that. Okay. Cool. Okay. Sorry about hearing the internet is not doing well. All looks good on my end. I have some metrics that measure the quality of my internet, so I guess it's probably the video distribution network or something. Hopefully, it stabilizes soon. Anyway, so we can see here the mark is 0.55. Okay. 0.55, I meant to say. So we may get filled on those 5 cents very soon, hopefully before the session is over. If not, we'll talk about it tomorrow. So anyway, so let's begin. You may call me stubborn, but I want to find an iron condor. We need to build an iron condor against this trade. This is a positive Vega trade, and we need to find a negative Vega trade. So I'm going to continue and persist on the pursuit of identifying that type of trade. And if I don't find it, then I will not find it. Of course, with the VIX being so low, it's every day is more complicated, but it doesn't mean that it's not worth it to try. Okay, so next Friday is 30. The Friday after is May 7. This stock, Twilio, has earnings on the 5th, so we cannot use that one. So what about Roku? Is it before or after the 7th? So Roku is 1, 2, 3 on the 6th, so we cannot. What about W? So W is May 6th. We cannot. What about PayPal? We are, by the way, in case you didn't know, we are in earnings season. So it is expected that this happens. I will skip Biogen because of the lack of liquidity. Caterpillar, earnings on the 29. Vertex, earnings on the 29. ETSY. Christian, I understand the COP trade is indeed complex. I get it. But, it's no way these type of trades can be taught by one day having a lecture and you get it. It's just not possible. It's too much information. So we learn through repetition. And the fact that you have seen it once means that the next time I do it, you will grasp it to a deeper degree. And the next time even more. And maybe the time after, then you will feel inspired enough to practice it in a demo account for yourself, and then when you see it working, you will get at some point ready to start trading it live. So this is how we learn, I would say, everything in life, isn't it? So so be patient with it. I mean, you can see for a while. I mean, to be honest, I don't track results this way, but just kind of to kind of work a little bit on our confidence, if you wish, which is important to trade well, isn't it? We have to be confident. So if you think about the trades I've been taking in the room, I don't know, for over 2 months, So if you think about the trades, the vast majority of the trades have been profitable. And why is that? And when we have not been profitable, it's been either break even or tiny, tiny, tiny losses. I mean, if you remember that funny Iron Condor with Facebook, it was like minus 25 or something like that. So um, again, why do we achieve this type of results, which are, if I was to use a title to classify or to kind of refer to the type of trading that we do in the room, I would think of safe. Probably is a word that explains it very well, right? Doing all those adjustments, tweaks, rolls. What does it do to your trades? It keeps you in a very safe position, where even when you're wrong, it's not so bad. Okay, it's definitely better than what you plan at first. You have improvement as the trade progresses. So again, the price to pay is that it's more complex, and then you need the patience and the time to learn it. Okay, so Christian, I appreciate your comment, and I know your comment comes from a positive angle. But for everyone watching, even for yourself, just give yourself time, okay? Because these things take time to learn, okay? This is not going long, going short. This is much more sophisticated. Anyway, I'll skip that one because I don't have information about earnings. Zillow, May for Qualcomm, it's 428, Beyond Meat, 5.6, T-Mobile, 5.4, Starbucks, and some of you may be thinking, Jose, this is like the last week. You're going through all the symbols, and it's no, 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 no. You are stubborn, my friend. Some of you may be thinking like that, and my answer to you would be yes, I am stubborn. Why am I stubborn? Because I know that I may get no's for everything, or maybe I only got one trade that gives me a yes. But if I find that trade that gives me a yes, it's going to be very good, because to give a yes for an iron condor in a context where the VIX is just dropping and dropping, it means that there is a lot of premium built in. Second, now I have an opportunity to offset my portfolio. So I want to teach you that type of approach to trading, where you gotta be persistent. You cannot just accept whatever or give up in your research. You need to find what you need to manage the risk of your trading. Wow. So in the end, it seems that it will be all no's. Here we go. We went to Comcast, and also it was a no. Okay, good. So not an issue. Okay, so I'm gonna customize the scan and rerun it for bottom, just in case. And while we're doing that, I would like to look at a little bit of directional trading. Okay, and given what we saw on the S&P, thank you so much for that, Christian. When looking at the S&P, we saw earlier, we talked about it, that the climate is up, UFOs are below. The climate had that little reset 3 days ago with a red dot. So again, all of this is telling me that if we just got filled on the, here we go. So let's take care of the trade. Okay, so we just got filled 5 cents. So right now, if you look at the COP trade, we only have a strangle. That's all we have. So it's now time to go ahead and sell that strangle, 57.49 strangle on COP. Okay. So let's do that here. So analyze COP, analyze and sell strangle, and it's going to be where is it? Why is it not showing? Analyze a sell and strangle. Oh, this is funny. It doesn't show. Here. I'm not sure why this is happening, guys. Okay, so I'm just gonna do it on the trade tab. I'm not fully sure what's happening. Maybe I need to reset TOS. Anyway, I'll do it here directly. So we are selling the 49 put, and we are selling the 57 call. Okay, so that would be 63 cents if you do it at the midpoint. I'm just gonna go with it. I'll give you also a few seconds, so maybe you want to take a screenshot or you want to look at it carefully. I want to point at the fact that what matters is that you are doing May 7, that you have -1, -1, so you're selling both options. The put is the 49, which is below 50. The call is the 57, which is above 56, and that will pay you 63 cents. Okay, that will pay you 63 cents. So we're gonna do that. I'm just gonna go for it. 1, 2, 3. Send. Hopefully we will get filled. We just got filled. Very nice. So we just collected 63 cents. So if I go back to TradeStation, I can now log this in at 63 cents. That's what we got. Okay, and therefore now I'm gonna get rid of that, and this is what we got. So worst case, we're gonna make $43. Best case, we're gonna make $143 per contract in this trade. We cannot lose any more, including the earnings. Okay. Now, here's what sometimes happens with earnings. I'm sorry, because we should be now planning new trades. Okay, but since we got filled on that, I want to add a bit more because I want you to be ready for whatever happens. Okay, so here is what often happens in earnings. Okay, and maybe we can look at the chart of COP. Okay, we can look at the chart of COP. I'm gonna go to a daily time frame. One more time, load EPS postings. Again, every stock is different and it's not always the same. But if I was to zoom in, like for example, this instance, right? So what happens? The closing price that day was down here. Okay, the opening price next day was here, and from here, that market rallied all the way. But just a few days later, it was back to where everything started with the earnings result. Okay? So this happens many times, that you have this earnings result, big jump, big move, sometimes 5%, 10%, whatever, and then everything is undone. Sometimes even intraday. Okay, so what do you want to be ready for? Well, take a look at this. We just got filled. And this, by the way, is not going to be an OSO, Siderman, but in this case, I will anticipate to place the order, and you will see why. So I just got filled on those two options, the 49 and the 57. And what am I going to do now? I'm going to add a closing order, good till cancel, to close at 5 cents. I'm going to do that. Okay? So let me do it, and then let me explain what I'm going to do it. So I have an order now to close the 57 call that I just sold at 5 cents. Send. And I'm going to have another order for the 49 put, which is the other option I sold, and I'm going to be ready to close it at 5 cents as well. Okay, and this is going to be good till cancel too. So those orders stay there. Okay, good. So why am I doing that? Okay, so now I got, all my COP trade here. Okay, and I got orders waiting to get filled. Two are orders to buy for 5 cents, the 57 call and the 49 put. And by the way, since I already did that, okay, this option to sell the 56 call, I almost forgot. That would be a mistake. I need to cancel it. We don't want that order any longer. Okay, so I just got rid of it. Okay, so we are now left with those 4 units and one order to close the 2 shorts at 5 cents. Why? Because let's say, okay, and I'm going back to today's date. So let's say, it's not today, okay? But let's say earnings was today, okay? And next thing you know, from here, which is the current price, that stock gaps up here in the middle of the UFOs. So what's going to happen to the put we just sold? What's going to happen to the 49 put, okay, which is here? Well, it's going to become 5 cents. Why? Because the stock gapping up is going to decrease the value of the put. And on top of that, the fact that earnings already took place will imply a massive drop on implied volatility in those options. So it's going to be quite easy for that option to become 5 cents. So, if the gap took place all the way here and we were to manage to close the 49 put, what happens now if the stock was to react to the UFO? And as I said before, many times whatever happens with earnings is undone very quickly. So what if that stock now was to fall? Well, if that stock now was to fall, you would fully benefit from the beauty of having a strangle, which is you're gonna have increasing deltas thanks to gamma on the way down. And now you're gonna make, instead of making $143, you're gonna make way more than that very quickly. Okay. By the way, let's say what happened is that the stock gaps up and then drops a bit, and let's say some new UFO forms, and now it goes back up. Well, with that drop, when it gets here, okay, the 57 call you own, you may be able to close it at 5 cents. So again, if the stock goes down and then rallies and goes to the moon, again, you now have a long strangle for which you have closed the shorts. So you have unlimited potential for profit above and below, and you just want to let it go all the way, because the more it goes, the more you make. Take a look at this in the risk profile. If I was to duplicate the strangle that I have, okay? If I was to duplicate the strangle that I have, that cost me $20, okay? It cost me $20, but then I got paid 63 cents, which are the $43 I will make no matter what. I got $43 of credit. But now I'm gonna buy one option for 5 cents and the other option for 5 cents, so I'm giving up 10 cents. So now, worst case, I would make 33. In other words, that strangle now cost me a negative, okay, so it's a credit of 33. So what happens if I chart that strangle? Notice that now, worst case, you are going to make 33. But if the stock really keeps going and going and going, and let's say it goes to 60, so when it goes to 60, you are making, $450. So you are not capping the profit of 143. You are now allowing this trade to go, all the way. Okay. And it happens often that during earnings, you have this very fast move in one direction and then very fast move in the other direction. And you take advantage of that first fast move to close one of the short options we just sold, either the 49 put or the 57 call. So lots of stuff. I will just close it. Okay, I will leave it the way we had it. We have the orders in the system. Hopefully I didn't drive you all the way crazy. And this is making sense to you guys. Give me some feedback if that's okay. Hopefully you guys are with me. And definitely tomorrow we are back together. So I'm happy to kind of review it and so on. Okay, again, earnings for COP is in May 4. May 4 happens to be Tuesday. So next Wednesday, when we are back together, we will get the answer to this. We'll see exactly what happened. Okay, but so far, worst case, we're gonna make $43. Okay, so looking good, doing the right thing. Again, always protecting the risk, always doing the right thing with our accounts. Okay. Very good. Got it. Perfect. Okay. Siderman since not filled yet. Got you. Yeah. So back to the S&P. Okay. And normally we would have discontinued the session on YouTube since a long time. But again, we only got 7 minutes left, so we will not discontinue the session on YouTube. We'll just complete the session today. But look at what's happening right now on the S&P. Okay, so what do we have? So first we have this up climate as we discussed, but then what's the other thing we have? We have this major congestion here, which this typically leads to either a breakout to the upside or a breakout to the downside. Okay, the market is very undecided. Is it gonna go up? Is it gonna go down? Statistics suggest up. The UFO suggests up. We'll see. But, you can see this is the same thing that happened there. And what happened next? Massive move. Okay. So from a directional point of view, I would like to explore opportunities to be directional, thinking of catching a move and riding a move to the upside, expecting the market is going to start making all times high, and if that's the case, benefit from that with a specific stock. So I'm going to go through the list. We have very limited time though, so I'm not sure we're going to be able to put it together today. But if we are not able to, then we will continue tomorrow. Okay. So pre and post market is 49. That's not good enough. Regular session is good, but unfortunately we cannot do anything here because this is 210. Our reference is 216, so we are not aligned. So I'm going to go for BX. Ahmed, for me, if I will join you in this trade, my risk will be 20 and the profit will be 77. Okay, you got filled at different prices, or Ahmed, I believe you were doing the normal calendar instead of the double calendar. Am I correct with that? Do I remember well? So, well, BX, I'm going to pass because it's 23 out of 8. So this is a market which is very, very extremely extended. So Morgan Stanley. So we are talking about 49%. This is not good. What about pre-post market for Morgan Stanley? 48, no good. AZN. This is 10 out of 4, so not good. Ally. Oh, so you closed the normal calendar last week. Okay, but then did you re-enter this trade or something like that? So 29. So 5 out of 7, that's acceptable from a probability point of view. 36% is not. Regular session provides 51, that is acceptable. And the reference price is about 49. And we do have a UFO around 49. Okay, so this is a market that allows us to put a trade together with Ally. So let's explore this a bit deeper. Looking at the monthly time frame, this is making all times high. What a move. This is absolutely unbelievable. It's like 500% return in a year or two. Anyway, so this is looking good for a trade. Just concerned about liquidity for Ally. Let me take a look. Let's take a look at liquidity. Earnings for Ally are on July. We don't have July, so we're gonna have to go with June. And liquidity is pretty standard, pretty okay. So it's good. Okay, so let's take a look at this. Okay, so no target. Okay, no target. It's gonna be simple. To be honest, we got 3 minutes to go, and we will have time to put this trade together. We're just gonna buy a call. This is not a complex option strategy. Why are we gonna buy a call and that's it? Because we are playing an all-time high play, and I don't want to cap the profit. I want to let the move to happen, and then I'm going to tweak it to lock in profits. But I don't want to cap the profit from the beginning doing a spread. This is going to cost me more, but at the same time, I got the benefit of enjoying all times high. If that was to happen with the S&P, that stock, which is making all times high, will probably follow. So our UFO is going to be here. 49.01 is going to be our entry. Okay, so 49.01 is going to be our entry. Analyze and buy a single option. 49.01 is our entry. Okay, and we are not setting any target. So the only thing I want to do is I want to buy an option with a delta around 30. Okay, which is gonna be maybe the 55. Wow, the 55 only have 16. How come? And the 50, of course, is at the money, but 45. Let me take a look at that. Interesting. So, 1 second, I just put my mouse in the wrong place. So, yeah, 50, 55. Yeah, correct. Correct. Delta is so much less. So much less. Okay, so what if I go to September? 50 and same story, similar story. Let's try September out of curiosity. I mean, ideally you would have July to take advantage of earnings, but we don't. So if we do September and we do 55, that's about 30 delta. So we're gonna go this way. The trade is actually quite reasonable. It's $154. Okay, of course the stock is a $50 stock, so it cannot be that expensive. But again, it's not like we're buying a call and that's it. Then we'll do things to the trade, assuming the trade will work in our favor. We'll lock in profits and we'll do some additional adjustments. Okay, but for now we are just gonna buy the 55 call that expires in September 17. It provides our 30 delta that we want. Liquidity is relatively acceptable from 212 to 188. Make sure you shave it. Okay, and we're gonna go with it. So 55 call for Ally that expires in September. So let's buy it. Okay, and we're gonna buy it with specific instructions. We will review this tomorrow, so I'm gonna have a day order. Okay, the instruction is we are going to buy if Ally is less or equal than 49.05. Okay, and I'm just gonna go with a market order. We can talk about this more in depth, but because of the time we cannot. So I'm just gonna do market order Ally less or equal than 49.05, and that would be the trade that we would place, to position ourselves to take advantage of this potential all-time high. I place the order. I want to while I place the order, I want to rephrase. Here's the order Ally. I want to rephrase the fact that this trade would have an expected risk about $155. You may want to count, let's call it 200 risk, $200 of risk. So make sure you position yourself with the right amount of contracts given your risk appetite. So that would be the risk of the trade. The most you will lose is 200 per contract. Okay, and then if it goes, we're gonna start profiting. Again, the moment the movements happen, we're gonna work on it to lock in profits and create additional advantages. Okay. Cool, everybody. We're gonna call it a day. Hopefully today was good. I had fun. Hopefully you did too. We got two extremes. One trade is non-directional and very complex. The other trade, Ally, is directional and very simple. Today, Fairmont, it's a 2-day thing because tomorrow the EMA will change and we may use that UFO to do the trade if we didn't get the fill on the bottom UFO today. Okay, so that UFO is only valid for today, and therefore the day should be day only, not GTC. Very good, everybody. I will see you tomorrow, same place, same time. My pleasure. As I said, lots of fun. Hopefully, you too. See you then. Keep up the good work. If you have questions, get them ready for tomorrow. Send an email or get them ready for the chat box. Yeah, Ahmed, Delta is 30 something. We cannot choose much, isn't it? That's what it was. We only have $5 strike price increments with a September expiration. So, again, we'll talk more about further adjustments with Delta. I mean, I'll have very, very, very nice, let's call it very nice surprises for you to see later in the year as we are developing a series of tools that you guys are gonna develop, are gonna love. But again, too soon for me to share because it's not ready yet. Anyway, you guys take care. See you soon. Bye bye.